Let's talk about qualifying for the VA loan. Some people ask, well, if I pay down this debt, will it look better? If I could save a little bit more money in my bank account, get a gift from my parents, will it look better? Really, it's a math calculation. What is your monthly housing debt? And add to that your monthly debts that you owe. When we pull your credit, we can see what trade lines you have. A trade line is an account with a minimum balance, minimum payment that must be made. So we add together those debts and add it to the housing payment that would be involved with the new housing that you're getting. The principal, interest, taxes, insurance, HOA fees if there is one, anything else associated with your housing payment that must be paid. They don't count things like cable, telephone, because you can cancel those things if you get in a tight situation. These are things that you're obligated to pay on in order to own a home. So we take those debts, add them together, and divide by your gross monthly income. That's the debt to income ratio. Normally for a VA loan, it needs to be below 41%. However, with extenuating factors, whether it's more money in the bank or your situation with what kind of child care you have or don't pay for child care because your spouse stays home, there are extenuating factors that can be considered to push that ratio quite a bit higher. I would urge you to consider whether you really want to do so, though, because we really want your monthly payment to be comfortable, something that's not going to cause you stress in your life, something that if you move and rent out the house to a tenant, that's going to cover it, or at least enough to make you comfortable keeping that house as an investment. So that's the debt to income ratio for qualifying for the VA loan.